The Nikkei 225 is sitting at 64,999.41, and right now, nobody knows what to do. It just printed an all-time high and immediately handed back nearly 500 points. The headlines are screaming caution because the AI rally that fueled this breakout is suddenly being questioned. But here is what separates the amateurs from the pros. Pullbacks inside a raging structural bull trend are where generational entries are born, and traps are set. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end, because I'm handing out 3 exact entry and exit levels you can execute right now, with stops and risk-reward logic attached. Right now, I'm giving you the instant market verdict. The session bias is by the dip, fading the intraday noise within a high-momentum uptrend. But this is not a blind bid. The structure is rock solid until it is not. The one invalidation level that proves this entire bullish architecture wrong is 63,530. Write this number down. If the Nikkei breaks and closes below 63530 on the 4-hour chart today, the whole structure shifts, and we move from accumulation to distribution. As long as price holds above that, every red candle is a potential reload. Get that number tattooed on your trading brain. Now let us walk the charts from the mountaintop down to the trenches, because the timeframes are telling a story that most traders will miss. On the weekly canvas, this market is a beast. We have a strong buy reading, price levitating above every major moving average. The 200-week average is a distant memory down near 53293. The 50-week is at 60091, the 20-week at 62492. The Nikkei is trading almost 5,000 points above its 20-week mean. That is not a weak market. That is a market that is priced in a regime change in Japanese equities, driven by structural reforms, buyback culture, and a yen that refuses to strengthen. On the daily time frame, the picture is equally vicious. The MA5 at 64478, the MA10 at 63713, the MA20 at 62,492, all slopes are pointing north at an aggressive angle. The RSI on the daily sits at 64.49, not even close to overbought. There is room to run. The MACD is printing 1613, still deeply positive, though we need to watch for any bearish divergence if price chops sideways for too long. This is where the 4-hour and 1-hour charts start injecting nuance. The 4-hour trend is still strong buy, no question, but the 1-hour has flipped to neutral. That 1-hour neutrality is the trap. It lulls late longs into panic and shakes out weak hands, while the 5-hour chart still screams strong buy. This is a classic compression pattern, higher time frame momentum pausing, lower time frame noise creating doubt. Here is what most traders miss. When the 1-hour neutralizes but the 5-hour and daily never flinch, you are not witnessing a top. You are witnessing a flag or a pennant that will resolve in the direction of the dominant trend. The 200-hour moving average is not even in play. Price is miles above it. The 20-hour average is acting as dynamic support near 64400. We also have key horizontal levels, support at 64,068, which is the first line in the sand, and then the brick wall at 63530. Resistance is clearly marked at 66755, the record high pivot, and stretch target at 67292. Those levels are not random. They are liquidity zones where stops cluster and where the algorithm hunts. Now let us connect the Nikkei to its shadow, the yen. This is not just an equity play. It is a leveraged bet on the US dollar to Japanese yen intervention ghost. If you are not watching the dollar-yen right now, you are trading blind. Japanese exporters live and die by the exchange rate. A weaker yen has been rocket fuel for the Nikkei. But yesterday's retreat from record highs coincides with whispers of verbal intervention from Tokyo, and the AI rally sparks caution narrative. What happens if the Ministry of Finance steps in and dollar-yen craters by 2 big figures? The Nikkei will get a body blow because the carry trade and exporter earnings narrative reverses violently. The yield differential drama is still supporting yen weakness. The Bank of Japan remains stuck while the Fed keeps rates higher for longer. That spread keeps a bid under equities. But the ghost of intervention is real. If US dollar to Japanese yen loses the 155 handle and accelerates lower, Nikkei will test those support levels faster than you can click. Conversely, if dollar yen rips through 157.50, the Nikkei will vaporize 66755 and march straight to 67,292 within sessions. The cross-asset mutual validation is crystal clear. Right now, dollar yen is holding, and that tells me the Nikkei dip is buyable. The 1 to 2 week directional lean is bullish continuation, targeting new highs. The exact event that would invalidate this thesis is a confirmed BOJ rate hike signal or an actual currency intervention that drops dollar yen below 154. Absent that, the path of least resistance is up. Gold and oil are also whispering to us. Oil prices are elevated but not panic spiking, which means global demand expectations are intact, supporting Japanese industrials. Gold is bid, reflecting geopolitical uncertainty, but not at a level that implies a risk-off cascade. The risk appetite remains constructive. Most people will click away right now, but this is where money is made. Keep watching. I am about to give you 3 precise strategies carved out of this exact structure. We start with strategy 1, the sniper, for conservative traders who only want to enter when the market proves it respects the trend. The trigger condition is a successful defense of the 64,068 support zone. Wait for price to dip into the 64,150 to 64068 region on the 1-hour chart. Do not just blindly bid there. You need a confirmation signal, a bullish engulfing candle or a pin bar rejection with a wick below 64,068 that gets immediately bought. Once you have that, you enter long. The stop loss goes at 63,500, just beneath the structural invalidation level. That gives you a reasonable cushion below 64068 and under the second support. The logic is simple. If 63,530 breaks, the pattern is dead and you do not want to be in this trade. Target 1 is 65,000, which represents the psychological level and the area where price is consolidating now. Target 2 is 66,755, the record high. The risk-to-reward ratio on this setup is approximately 1 to 3, based on the distance from entry to stop versus entry to target 2. This setup is voided if the price slices straight through 64068 without any bullish reaction and closes below on the 1-hour time frame. Patience is the edge here. Strategy 2, the active trader. This is a standard play for those looking to ride the moving average structure without waiting for a deep retest. The entry condition is a pullback to the MA10 on the 4-hour chart, which aligns closely with the 63,713 level. When price retraces to the 63,750 to 63,700 zone and the 4-hour candle shows a sharp rejection, you enter long. The stop loss is placed at 63,500, again respecting the hard invalidation floor. The reasoning for the stop is identical. Lose that level and the trend structure degrades. Target 1 is 64,478, which is the current MA5 dynamic, and target 2 is 65,500, a psychological extension before the record high. Once target 1 is hit, I want you to move your stop to break-even and trail it manually using a 20-period moving average on the 1-hour chart to capture a potential surge towards 66755. This strategy captures the mean reversion nature of a bull trend where the moving averages act like springboards. Most traders miss these bounces because they wait for the perfect textbook entry that never comes. Let us see how aligned we are. Type your Nikkei 225 closing level prediction for tomorrow's session in the comments right now. I am reading every single one. Put your number down and let us see who has their finger on the pulse. Strategy 3, the aggressor. This is high risk, counter trend, and only for those who know how to lose small and manage risk aggressively. If you are not comfortable taking a loss in minutes, skip this. The premise is fading the AI caution exhaustion against the record high resistance. The entry is a momentum chase on the short side if price rallies into the 66,550 to 66,755 supply zone and then stalls violently, perhaps with a shooting star or a bearish engulfing on the 15-minute chart. You sell short with a tight stop loss at 67300, above the extended resistance 67292. Your targets are 65,64480, capturing the liquidation of weak longs who chased the breakout earlier. This is a pure mean reversion scalp against the trend, so risk must be microscopic. The moment price fails to move lower and reclaims 66800, you are out regardless of stop. Only execute if the US dollar to Japanese yen simultaneously shows a bearish rejection at a key technical level, adding confluence to the Nikkei pullback. I cannot stress this enough. Counter-trend trades require sniper precision and zero-ego risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions held through high-impact news like BOJ statements or US CPI. Stops are non-negotiable. Always size based on the distance to your stop, not your hoped. We are closing this loop with the one level that matters most for the next session, 65,000. Price is churning right here. A clean acceptance above 65,000 on strong volume opens the door to a swift retest of 66,755. A rejection and grind below 64,068 risks a fast move to 63530, where the bulls will make their stand. That battle determines the week. Tomorrow, we focus on any fresh BOJ rhetoric and the Tokyo Open reaction. If yen pairs gap violently, the Nikkei will follow in a heartbeat. I will be here, breaking it down. And if you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen, because the liquidity games being played there are unmissable. Smash the like button if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage. My name is the founder of Alpha Market Meridian. I will see you in the next one. Trade the truth.